Hello, friends. Welcome to March. Get ready to move your clocks up an hour and have a little more daylight. Welcome back to another video update. Lots going on in the world. Let's do a quick check-in on the stock market and the economy, and then let's talk about the conflict in Iran. All right, here we go. The major stock indices were flattish to slightly down, call it, in February. They remain barely up for the year, except for the NASDAQ, which is actually down a couple points, but not much action overall. AI-driven disruption fears, such as software, contributed to increased volatility. The markets rotated away from the beloved mega-cap tech stocks that have been largely responsible for the U.S. stock market's intense growth for the past 3 years. The rotation into lagging, or call them average stocks, helped offset contractions elsewhere in the market and also rewarded diversification. Love to hear that. Diversification still works. Tech stocks are not going away anytime soon. We know that, but we have been looking for a healthy rotation, so that's positive. Quick update on monetary policy. Trading in the federal funds futures suggests that the market anticipates 2 rate cuts now in 2026, although our economist still thinks there will be just one. Current estimates signal an October to December timeline. Now, both in 2024 and in 2025, we saw rate cut anticipation early that didn't come to fruition until the end of the year, so that pattern could be again the same this year in 2026. All right, let's turn to Iran. We don't know how long the airstrikes will last. We don't know how this is going to evolve. Hopefully it doesn't get too crazy, but the question for the markets, we'll focus on the economy and the markets, is will this conflict lead to an actual disruption in oil supply? That's a big deal. History offers some perspective. So first of all, Iran and Israel exchanged missiles twice in 2024. Oil continued to flow normally. The same was true in June of 2025. Obviously, this time the military action is much wider, much more intense. The U.S. is involved in a major way. But even before the start of these recent airstrikes, the oil market's risk premium significantly widened, reflecting concerns about potential disruptions of oil supply from Iran and other countries in the region. That means the markets kind of saw this coming and prices were creeping up. As military action continues, oil prices could rise further. But again, history suggests that once the conflict is in the rearview mirror, the price spike is likely to subside, and longer term, we see a fair value for WTI crude in the $55 to $60 barrel range. Couple things about Iran. They are a member of OPEC and a big oil producer, but not as much as you might think. Iran exports only about 1.4% of the global supply, ranking as the number 10 in oil exporters in the world. The other 1.8 million barrels per day that they produce go to serve their own country and their population, if you were wondering, of about 93 million people. The greater risk is if they block the Strait of Hormuz. Now, Iran has never blocked the Strait of Hormuz before, and we don't think they will because that would cut off their own exports. Okay, how about the risks to the stock market? Because of the decades of isolation, honestly, Iran's role in the global economy is fairly limited. More broadly, U.S. economies have relatively little direct exposure to the whole region. The S&P 500 generates less than 2% of its total revenue from the Middle East. Very small. That means if global stock markets come under pressure this week, it's likely driven more by short-term reaction to geopolitical headlines than by any meaningful hit to corporate fundamentals. That's a very important distinction. Overall, we expect minimal impact on corporate earnings, assuming the conflict is short-lived. Higher oil prices tend to benefit the energy sector while creating modest cost pressures for industries such as airlines and trucking. Makes sense. The picture would change if elevated oil prices were to persist for several months. In that scenario, it gets complicated. The U.S. consumers would likely see gasoline prices rise above $3 a gallon. We don't want to see that, pushing inflation modestly higher. We haven't talked about that for a while. So if that comes back in, that would weigh on consumer confidence, that would weigh on spending, and that combination, slower spending and stickier inflation, would complicate the Federal Reserve's decision making around future rate cuts. So, time will tell. The bottom line, the latest crisis involving Iran has pushed up oil prices and may put short-term pressure on risky assets. History suggests, however, that these episodes are temporary, with oil prices eventually easing back towards more moderate levels, and geopolitical shocks are a reoccurring feature of the markets. This is not the first or the last time we'll see something. Our message to our investors is simple. Avoid knee-jerk reactions to headlines. Stay focused on your long-term goals. I hope this helps. I hope you learned something new. Thanks for your time. Reach out anytime with questions. We'll see you next time.